In the next edition of It's About Money, my guest is Chad Riflin. He's the Credit Education Bureau Director at Catholic Family Center. We'll be talking about short selling. And stay tuned and watch the program. Hello and welcome to another edition of It's About Money. I'm Nanette Nokan and thank you for joining us. In the recent past, with the real estate crisis, short selling has been a popular strategy for many homeowners, unfortunately. My guest today is Chad Riflin. He is the Credit Education Bureau Director at Catholic Family Center, and he's here to talk with us about what short selling means and how it affects your credit score. Chad, thanks again for joining us.
Great. It's good to be here. I think this is a great topic to talk about, and I'm hoping that this will definitely give people some good direction about short sales and its effect on their credit scores.
Sure, because it's not to be taken lightly. So help me define for our audience what short selling means.
Well, short selling in a nutshell means that someone is selling their home with the permission of their lender for less than what the balance is on their mortgage. And then there's a balance that is left over that's referred to as the deficiency balance that borrower is still responsible for, even though they've sold the home and they're moving on from that property.
I see. So basically, if someone needs, is there a reason that someone has to do that? That the bank will say, go ahead and do it? Are there certain qualifiers, or is just whoever wants to do it can do it?
The individual always has to have permission from their lender. Mm-hmm. Short sale is not something that someone can just decide to do if they'd like to. It typically happens when the lender realizes that the individual is not going to be able to receive at the current market conditions a payment for the home that is going to satisfy the loan balance. So the lender realizes this is pretty much the best that they're going to get and to avoid foreclosure on that home.
I see. So they either allowed the short sale so that they could at least resell the property and
Correct.
Hopefully recover, or they could just hold on to the mortgage and not receive any payments, which doesn't make sense.
Right. So the benefit to the lender is then they don't have to go through the process of taking over the property, going through the long foreclosure proceedings, which can be costly, and then having to find a way to resell the home on their own.
I see. So really, that's a very important point. In short selling, that's the responsibility of the homeowner.
Correct.
Whereas in foreclosure, it becomes the bank's headache.
Essentially.
All right. And that's how we get to find banks allowing this short sale to happen.
Right. It's still not in the bank's best interest, but it might be the best of options that are available, so the least of two evils in a sense.
Sure. So in a poor economic time, short selling could be an alternative that homeowners might choose if they lost their jobs or some change in financial picture that does not allow them to maintain the mortgage payments.
Right. It seems like those are the conditions that usually lead to someone choosing a short sale as their best option. But there are definitely some things that I think they should be aware of that are going to be the consequences of that short sale.
Got it. Okay. So if a homeowner had the financial difficulty, rather than waiting for a long time to pay the loan, to contact the bank, they would want to contact the bank and apply for the short selling approval.
I think in any situation where a homeowner is facing issues with repayment of their home loan, the best policy is always to communicate with your lender as much as possible. A lot of lenders have loss mitigation departments where they specialize in finding options for homeowners to avoid foreclosure. So the best thing for any homeowner to do as soon as they find themselves in a situation where they know it's going to become difficult for them to repay is to contact their lender, explain their situation, and see what their options are.
To work with them as opposed to avoiding the issue and then coming up short on options.
Absolutely.
So first thing to do is contact the lender, and then they'll tell you what process they need to go through.
Right, because each lender's process is going to be different as well. Some lenders are obviously more strict in their lending criteria, others are more flexible. Some might have specific programs that they've already set up internally to help folks who are going through challenges that might be temporary to get them over the hump for a period of time.
I see. Now, what kind of protection, so to speak, does each party have? I mean, will the homeowner be kicked out of their home during the process of short selling? Is that something that typically happens?
No, with the short sale, you are still in control of the sale of your home. You're still in control of the deed of your home. Your lender is just granting you permission to still sell the home even though you're going to owe money after the sale of the home. So it's much different than a foreclosure in that sense, where you're not facing a situation where you might be evicted from the home, essentially.
Sure, yeah, you wouldn't want to be evicted. That would be a horrible thing to have to go through. Now, short selling, as we talked prior to the program, is not really a new strategy, but it's become just more popular.
Right, it's something that's been around for quite a while. I think it's just been an option that's been brought up more and more now because of the vast foreclosures that have been happening, and people just finding themselves in a situation where the value of their property has decreased, which is very unusual to us nowadays, given the fact that homes have increased in value over the past several decades. So I think that's why short sales they seem new, even though they're not really new.
It's just more popular, so you hear more about it. So really the objective is to avoid a foreclosure, so you try to do a short sale.
Correct.
Now, what about if a homeowner can't pay back the difference? What happens to that homeowner?
Well, that would be with the deficiency balance on their short sale. And if they can't pay that back, they face the same risks that they would face in not being able to pay any other debt, where that lender could eventually sue them, obtain a judgment on that balance, and then that means they would have the ability to then possibly garnish their wages or seize different assets that could recoup the balance on that loan.
I see. So it's not free and clear. A homeowner who is going through short selling doesn't mean that they're going to relieve themselves of the difference in the deficiency.
That's correct. I think that's very important for folks to understand, that it's not forgiveness of the balance. In certain cases, you can negotiate with a lender to not report the deficiency balance on your credit report, which does have some benefit to your credit score. You might save about 35 points on your score if you're able to negotiate that fact, but that balance is still owed.
I see. Okay, so it has to be paid, and if it's not reported, it could work out if you can repay it back. But otherwise, it can be a big ding of 35 points. Actually, let's talk about the credit score. What is the impact of that? So someone, say, has a great credit score, they have to short sell because they lost their job. What does that mean?
That's a very good question, because I think one of the misconceptions with short sales is that you are somehow saving your credit score versus going into foreclosure. And from a lot of the recent studies, even some of those that have been put out by FICO, which is Fair Isaac and Company, one of the original credit score creators, is that short sales have the same impact on an individual's credit score as a foreclosure. So you're not necessarily saving your credit score specifically by doing the short sale.
I see. So one would see, let's say somebody had a good score of 750. Would it be typically cut in half if you did a short sale? Is that too specific of a question?
Well, they've done some studies recently to see what kind of an impact it would make on someone's credit score. And when it comes to credit scores, obviously things can get very complex because something that affects one person's credit profile will affect another individual's credit profile quite differently. So what they've done is they've taken kind of a snapshot of 3 different credit profiles, maybe an individual with a score of 780, another individual with a score of 720 or 680. And they found that individuals with lower credit scores stand to lose fewer points than the individual who's starting with the higher credit score. So if you're starting with a score of 780, you stand to lose maybe about 150 points from your credit score through a short sale or a foreclosure.
See, okay. And so you're in the lower end, don't have a lot to lose.
Not as much to lose, but it's still a pretty significant impact. It can still be about 100 points or so off of your credit score. So someone can go from a position of having almost an excellent credit score to having a poor credit score from that one particular item on their credit history.
Now, what happens if someone's credit score goes down as a result of short selling? Is that something they can remedy quickly? Or what impact does it have? Does it stick, and how long?
Yeah, unfortunately, there is no fast remedy to a foreclosure or a short sale, and a lot of other items that could be considered to be negative pieces of information on our credit report. It usually takes between 3 to 7 years for someone's credit score to fully recuperate from the effects of a short sale or a foreclosure. It doesn't necessarily mean that they'll be unable to obtain credit during that entire period of time, but it will definitely continue to impact their credit score negatively to some effect in some degree during that period of time.
So basically, if someone short sold, their credit score was, let's say, perfect, and they was impacted by the short sale because of a loss of a job or whatever, and they found another job and they moved to a different state and they want to buy a house, a different location, will they be able to apply for a mortgage, or absolutely not? No way, the bank does not want to talk with you.
Well, again, each lender's criteria might be different. I think the one benefit to the short sale versus foreclosure as far as your credit report is concerned is that when a lender looks at your credit report, if they see foreclosure on there, they are definitely going to require a greater period of time before you are able to apply for another mortgage versus the short sale.
I see.
So that would be a significant benefit to someone, knowing that there would be less time where they could then apply for a new mortgage if they did short sale versus foreclosure.
Okay. And I know the rules are different for every bank, but when we say short period of time, does that mean 2 years, 3 years, 5? What does that mean relative to?
As a relative ballpark, just rule of thumb, it's probably going to be in the neighborhood of 3 years.
I see. Okay. So the banks are really leery about taking on somebody borrowing because they might do it again.
Naturally.
Yeah.
That's the logic there.
Okay. So then let's say you have two people. Let's say one person was single and ended up doing a short sale, marry someone, they buy a house together. What does that mean? I mean, let's say the one person has a great credit score, but then the other one does not because they end up with a short sale. How does that application impact?
I think that's a good point to bring up because that's also an issue that comes up anytime folks are considering a mortgage and they're going to be heading into that mortgage as a joint application. And what folks need to understand is anytime that you head into a mortgage as a joint application with two parties, they are going to consider both parties' incomes equally, and they're going to consider both parties' credit reports and credit scores equally, which means both parties have to qualify from that full picture for the mortgage in order to be able to qualify as a joint application.
Because they're really applying equally. When you say joint, it's not really like, okay, you're responsible for 20% because I need your income to make me qualify for this mortgage.
Correct, and that's the main benefit of applying jointly is you're getting more income to qualify with, which means you're going to be able to possibly purchase more of a home that way.
Right, right. But otherwise it's challenging to do one has the income, one has the credit score. Got to look at both of them.
Correct.
So it's not really an easy way out, so to speak. So now in short selling, the homeowner signs on a realtor. Is it like typically the way one would sell a house, or how does that process work?
It's still a sale transaction, so you're going to have very similar activities in the short sale process, and there's going to be individuals there who can help you in working through that as well, but the lender is going to be the main driving force behind the process.
I see. So they could have a buyer for a much lower price, a buyer for that short sale if they wanted to, but that's probably unlikely.
Probably.
Yeah, right. They don't want to be in the business of that. So, so then let's say, for example, the homeowner does not pay the deficiency. It appears in their credit report. Does that become taxable income? I know you're not a tax preparer, but what are the implications of that?
I'm not sure. I don't believe that would become a taxable income at that time, but I think someone would want to check with a tax expert, as you said, to figure that out. But if they don't pay that deficiency balance, it is going to continue to have a negative impact on their credit score. So that's the important thing for someone to consider.
I see.
That I could definitely tell. But I think, there are some things they could continue to do to rebuild their credit after that time of the short sale.
So tell me about those. What are the kinds of things that they can do to rebuild the credit?
Anytime we talk about credit scores, in building a credit score, rebuilding a credit score, it really comes down to finding a way to reestablish on-time payment history on a regular monthly basis. Obviously, there still might be some glaring issues like the short sale deficiency balance, etc. But along the way, as we're continuing to improve on those items, it's also good to make sure that we've established some accounts that we can use for establishing payment history, such as a secured credit card or some other form of credit that is flexible in that sense.
I see. So you don't want a short sale and get removed from the credit tracking process. You want to rebuild it by showing responsibility.
Right. You don't want to just focus on the issue of the short sale and fixing that issue. You also want to rebuild other good pieces of information on your credit report at the same time.
Got it. Got to build those points.
Correct.
Okay. We'll take a quick break. My guest is Chad Riflin. He's Director at Credit Education Bureau of Catholic Family Center, and we'll be right back.
Before a disaster turns your family's world upside down, it's up to you to be ready. Get a kit. Make a plan. Be informed today. Learn how at ready.go.
And we're back. I'm Nanette Nokan, and my guest is Chad Riflin. He's with the Credit Education Bureau, and he's a director there, and it's through the Catholic Family Center. Thanks again for being here, Chad.
Thank you.
So let's talk about the credit score. I mean, that's sort of like everybody wants to have a perfect credit score on them. Tell me about, we talked about how having a deficiency can bring down the credit score possibly by 75 points. Has FICO recently revealed some of these scores, right, up or down, that could affect it? Can you talk about some of those things that may influence it?
Yeah, as far as credit score influences, there's a few different factors. Sometimes FICO presents a pie chart almost of the different influences of our credit score and what is the makeup of a credit score, what influences that score. Again, the number one influencer is our payment history. That makes up about 35% of our overall score. Secondly would be our balances, and more specifically there they would take a look at what our current balances are compared to our credit limits, and they would see what the ratio is of our balance compared to our limits. Believe it or not, anytime that our balances on credit cards exceed 30% of our limits, we begin to lose points in that particular area of our credit score. Then the scoring model looks at things like how long our credit score has been established for, and obviously the longer that our credit's been established, the better off we are. The model also looks at our mix of credit and any new credit that we've applied for, or inquiries or credit checks that have been done.
I see. So we look at payment history, we look at the ratio of the amount of debt against the available credit, and then we look at the recent credit applications and other factors associated with that.
Right. So what somebody would want to do is focus on things that would help them in those particular areas. So obviously, again, finding some sort of tool that would allow them to establish some on-time payment history. I know I mentioned the secured card before, which is a very easy way to go. And what that means is somebody would have to make a deposit to get the credit card that they're going to use for the repayment history on their credit report. And then what they'd probably want to do is use it once a month and pay it in full every single month, and thereby getting some good payment history on their report. Another thing that folks have heard is that anytime that you close out an account, it can hurt your credit. And that's a little bit misleading, but I'll explain why that's an issue that's brought up many times. The fact that you close out a credit card account never actually hurts your credit. What can hurt your credit is how that affects some of those other areas that I mentioned before, such as the length of time that you've had your credit established, and maybe the difference between your balances and your credit limits, because anytime you're closing out that credit card, you're also reducing your available credit. Mm-hmm. So you might be kind of shrinking the ceiling down closer to your balances, and it looks as if you owe a greater percentage of what's available to you. And then secondly, if you're closing out accounts that you've had established for a very long period of time, eventually those accounts will come off your credit report, and then it looks as if you have not established your credit for as long of a period of time.
I see.
So those are some of the things that folks should definitely be aware of throughout the process. But credit scores can be very complex. Mm-hmm. What affects one person's score will not affect another person's score the same way. And there's many, many different credit scores out there as well. A lot of consumers don't know or realize that there are over 100 different credit scores that someone can purchase online.
Okay.
And that secondly, the scores that we purchase online are never a true representation of what our credit score would be when we actually go to the bank.
So it's really not a good idea to pay for that credit score because it's not likely what the bank will be looking at.
It depends, I think, upon the situation. I think it's probably not worth it to do it on a regular basis just to monitor your credit score, because there are some free tools that individuals could utilize that would give them a ballpark figure of what their score would be. If you're going to be heading into a lending situation, then you still might want to purchase your credit score at least to get some sort of a mark as to where you might fall currently.
I see, I see. So it's important to just keep in mind, you may not want to cancel your very first credit card that you've been paying on time.
Exactly. And that's one thing that I do mention to a lot of folks is try to keep that first card that you ever had if you can, because that's very beneficial.
I see. That's interesting. Just remove the other ones. Even if it's a store credit, it establishes that point.
Otherwise, it's probably not going to have much of an effect on their credit score just to close the account.
So, and someone who charges their purchases through a credit card but pays it off at the end of the month, that's no negative implication because you're paying it on time, or is there one?
There could be.
Okay.
So I'm glad that you brought that up. Sometimes there can be if the individual is spending close to their credit limit every single month.
I see.
And what a lot of folks don't realize is that our credit card companies report how much we've spent, or our statement balance, as the balance on our credit history.
I see.
So even though we might be paying it off in full every month, as far as how that ratio is calculated, they're going to use how much we spent.
I see.
In many cases.
I see. So if someone only has one credit card, and let's just make up the number, a $5,000 limit, every month they charge $3,000 to $4,000, but they spend it and don't plan on paying finance charges, it could negatively impact that because that was the only credit that they have.
So even though this person is making this great payment of $3,000 to $4,000 every single month, and they're paying off all their monthly expenses that way and earning points, it could still negatively affect them in that area of their utilization, as they would call it.
I see. So in that case, one should apply for another credit card and just expand so that the ratio isn't so bad.
That might be one way to go about it, or even more effectively would probably be to request a limit increase on that current card.
Okay.
Because then they wouldn't be opening up another new account, which would get factored into that equation of how long they've had their credit established for.
I see. Well, great advice. That's terrific, because you don't want all these cards open. And I think one of the fears that many people have is having too many lines of credit or credit cards open, and then you open yourself for identity theft, so you just never know.
There's always that balancing act.
Right, that's right.
And there's always that balancing act between, the accounts that you're using to establish your credit, the accounts that you're using for earning rewards or points, and just to keep things managed well.
Sure, sure. So somebody who tries to get the free stuff from credit cards, like during the holidays, if you go to the mall, there's all these free things if you sign up for a credit card. That may not necessarily be good.
Probably not. The one area that can really be detrimental to someone is with the inquiries that are made when they apply for all those cards.
I see.
So you go to all the different stores and you attempt to get the discount or whatever it might be.
Right.
But the inquiries that are made specifically for credit cards do bring our credit score down.
I see.
Other inquiries don't have that same effect. For example, if we apply for a mortgage or a car loan, all those credit checks that are done within a 14-day window will only affect us as if they're one inquiry, because they know that we typically shop around for different interest rates for those types of items.
Okay.
And then conversely, there's also what they call soft inquiries, which means we didn't actually apply for a loan, but our credit was checked. For example, our own inquiry into our credit history.
I see. So that shouldn't affect, because if you keep looking at your own score, that could be detrimental if it wasn't one of those soft things, soft topics, so to speak. So, okay. So really, it makes sense to keep the credit card. Don't apply for too many, and then just make sure that the ratio is healthy, and pay your debt in time. Right.
That's it. So it is actually pretty simple when it's all said and done, even though it can seem very complex. And there's a lot of different messages that people receive nowadays, even from some experts out there who might make some mistakes in some of the advice that they're giving because of how quickly things change in the credit scoring industry.
Right. And you know what's interesting? There are people who never borrowed money because they pay by cash, and they get their credit score and they're upset that their credit score isn't high. But in order to make that credit score go up, you have to be able to show payments. Right. But if you don't need to take a loan, what's the point of doing that? If you've never really had a credit card and just use debit, it's difficult to establish that. And if you never borrowed from the beginning, your credit history is short, right? So someone may be complaining of a terrible credit score because they've never used credit. But my point to some people is, if you're never going to plan to borrow money, you don't really need to have a very healthy credit score if you're using everything in cash. You know, the old-fashioned, this is very rare.
Yeah.
But we still find people who are using everything with cash and all of a sudden, oh, gee, my credit score is so low. Score is so low. Or in some cases, they get rejected by a bank because they have no credit history. You're like, oh, how can someone be 55 years old and
Yeah.
have no credit history?
Yeah, it's interesting how we think about it, because we think of scores like test scores in school, where as long as I haven't done anything wrong, I should have the perfect score. Whereas with a credit score, we actually have to do certain activities to earn points
Right.
on that score.
So it's really how you want to use the points. And what's interesting with credit score is insurance companies now look at credit scores. So scores so that somebody who has auto insurance, and if they have terrible credit score, the insurance company would charge them a little bit more because it costs too much money to underwrite, and then they don't pay on time.
Correct.
Because it's really a behavior. I mean, that's really what it's saying, isn't it?
Yeah, there's been some studies done over the years that auto insurance companies have conducted where they've linked credit scores to someone's risk. And that's why that activity takes place, where we pay more for car insurance if we have a credit score that is less than favorable. And I've read actually in certain cases that it can be up to 50% more that some individuals pay for their auto insurance policies. So in that respect, it can definitely make a pretty big impact on someone's bottom line.
So basically what we need to do is just pay attention to maintaining a healthy credit score. Being passive doesn't help you. You have to do some activity in order to help that. So even somebody, a young college graduate who doesn't plan on borrowing a lot of money, no school loans, they really ought to establish their credit when they're really young and just have that credit card and keep it sacred.
Yeah, absolutely. The sooner the better. And I think the other misconception that a lot of people have is that somehow you have to go into debt and then pay your way out in order to establish good credit. And that's just not the case. You just have to have that regular on-time payment history established. And as I mentioned before, if it's with a secured credit card, it could be just one small purchase a month. Maybe somebody gets their gas or their food and they pay it in full. And in doing that, they're not really spending any more than they normally would either.
Right, I see what you mean. So it's just kind of to have that as an available option just in case they might need to use credit in the future. So it's basically the lower the score, the more expensive we have to pay for debt. Isn't that what the value of the credit score is?
For the most part, a lot of banks do use credit scores to qualify us as well, and there's certain mortgage programs that might be attached to a specific credit score that someone has to have to qualify. Then from there, how much the interest is on the loan is typically based on the credit score.
Sure. So then the lower your score, then the less favorable the terms might be for you.
Correct.
Or you might not qualify for those special programs.
Right, just have fewer options available.
Right. So it's really important to pay attention to that, and so just to repeat it, that would be paying on time, keeping the credit ratio healthy so that you're not overspent or spending too close to what's available to you.
Right, and optimally it'd be less than 30% of what the overall credit limits are.
Okay, very good number. And then just making sure that you establish it in advance and not have too many inquiries. So don't go to the mall and apply for all these credit cards.
Absolutely, that's right.
During the holiday season. So that is great. So, and then also just, so to talk about short sale, if somebody had, back to that topic, if somebody's having trouble paying their mortgage, they really shouldn't wait till the very end. They should work with their lender to make sure that the options are reviewed and that they talk about some strategies, including short selling.
Most definitely. Yeah, the communication with the lender is definitely the key piece to that particular issue, so that folks know what their options are and the lender's aware of what's going on.
Great. And lastly, the Catholic Family Center has a lot of wonderful programs, and you're developing some online programs for people to take advantage of.
Through our particular program at Catholic Family Center, which again is the Credit Education Bureau, we have tons of resources and information that folks can take advantage of. And we work just to educate people about personal finance and personal credit. And at our website, which is crediteducationbureau.org, we have some free resources there that folks can go and check out and use for their own day-to-day personal finance and personal money management.
Wonderful. Thank you very much. You always bring valuable insight to the program and to our guests, and I want to thank you for your time and expertise here at It's About Money.
Well, thank you again.
Thank you. And thank you, our guests, for joining us. My name is Nanette Nocon, and It's About Money.
Thanks for tuning in to today's show. If you have any questions for It's About Money, please email Nanette at nnocon@aol.com. This program was produced through Penfield Community Television in Penfield, New York.